Every trader has rules. Jesse Livermore had one rule: he refused to break even once, and it is the one rule Wall Street will never teach you. This is the classified file on the single most important rule in Jesse Livermore's entire trading career. The rule that saved him when everything else failed. The rule that Wall Street's institutions have deliberately kept out of every textbook ever written. Rule 1. Why Wall Street does not teach this rule. There is a question that every serious student of financial markets eventually asks. If Jesse Livermore's methods were so consistently successful, if they produced results so extraordinary that they have been studied for nearly a century, why are they not taught in universities? Why do business schools not include his principles in their curriculum? Why do the largest financial institutions in the world not train their employees using his framework? The answer is not that his methods are too complicated. They are not. The answer is not that his results were a historical accident that cannot be replicated. They were not. The answer is something far more deliberately calculated, and understanding it is essential to understanding why the rule we are discussing today is so powerful. Wall Street as an institution does not profit from traders who consistently win. It profits from the enormous volume of activity generated by traders who consistently lose and keep coming back. Commissions, spreads, fees, and the structural advantages built into every financial product are all designed to extract value from active participants over time. A trader who follows Livermore's primary rule trades infrequently, with precision, and at low cost. This kind of trader is the financial industry's least profitable customer. A trader who ignores the rule trades frequently, emotionally, and expensively. They generate enormous revenue for brokers and institutions through constant activity. They buy high and sell low in patterns so predictable that entire trading desks are designed to take the other side of their positions. They are, from the perspective of financial institutions, the ideal customer. This is why the rule is not taught, not because it does not work, it demonstrably does, but because widespread adoption of it would fundamentally undermine the business model of an industry that depends on predictable trader behavior for its own profitability. Jesse Livermore understood this dynamic clearly, and it made him deeply unpopular among the establishment figures of his era. The rule itself, once stated, sounds almost insultingly simple, but the gap between knowing a rule and actually following it under pressure, in real time, with real money at stake, is the widest gap in all of finance, and it is a gap that the financial industry works very hard to ensure that most traders never fully close. Rule 2. The rule stated simply. The rule that Jesse Livermore refused to break throughout his career can be stated in a single sentence: never add to a losing position. That is it. No complicated formula, no sophisticated mathematical model, no proprietary indicator, just one absolute prohibition that he applied without exception, without negotiation, and without the slightest sympathy for the emotional arguments his own mind would construct against it. To understand why this rule is so powerful and why violating it is so consistently catastrophic, we need to understand what happens psychologically when a trade moves against a trader, because the destruction that this rule prevents is not primarily financial in its origin, it is psychological. When you enter a trade and it moves against you, your brain immediately begins generating reasons why the trade is still valid. It finds data points that support your original thesis. It dismisses data points that contradict it. It constructs narratives about temporary weakness and inevitable recovery. It calculates how much lower the price would need to go before adding more would bring your average cost to a level where a modest recovery would put you back to break. This process feels like rational analysis. It feels like disciplined thinking. It feels like the kind of thorough, careful reasoning that separates experienced traders from impulsive amateurs. But Livermore recognized it for what it actually is: rationalization. The emotional desire to avoid admitting a mistake, dressed in the costume of logical analysis. The moment you add to a losing position, you have done two things simultaneously. You have increased your financial exposure to a trade that the market is already telling you is wrong, and you have made it psychologically harder to exit the position when the evidence demands it, because your average cost is now lower and the recovery required for break-even feels more achievable. You have not improved your situation. You have deepened it, and the market does not care about your average cost. It does not adjust its behavior to accommodate the level at which you needed to recover in order to feel better about your decision. Rule 3. How Livermore discovered this rule through catastrophic loss. Jesse Livermore did not arrive at this rule through abstract theorizing. He arrived at it through personal financial devastation of a scale that would have permanently ended the careers of almost any other trader in history. Early in his career, before this rule had become deeply embedded in his behavior, Livermore violated it repeatedly. He would enter a trade, watch it move against him, and instead of exiting, he would add to his position. The logic always seemed sound in the moment. The price was now lower than when he had originally entered, therefore it was an even better opportunity. His original analysis had not been proven wrong. The market was simply giving him a better entry point. This logic produced his first major financial collapse. A series of trades in which he continued adding to losing positions as they moved against him resulted in losses so severe that he was left effectively bankrupt. He had to borrow money to continue living and rebuild his trading capital from nearly nothing. Most people in this situation abandoned trading entirely. Livermore went back to studying. He spent months reconstructing exactly what had happened, not just the financial sequence of events, but the psychological sequence. He wanted to understand not just what he had done wrong, but why. What was the mechanism that had led him to make the same category of mistake repeatedly, despite his intelligence and his years of experience? What he identified was the fundamental conflict between the human desire to be right and the market's complete indifference to that desire. Every time he had added to a losing position, he had been prioritizing his need to avoid admitting a wrong call over his obligation to respond objectively to what the market was showing him. His ego had been making his trading decisions, wearing the disguise of rational analysis. The rule he established in response was designed to make this kind of ego-driven decision-making structurally impossible. By creating an absolute prohibition against adding to losing positions, a prohibition with no exceptions and no circumstances under which it could be overridden, he removed the decision from the emotional arena entirely. There was no longer anything to decide. The rule decided for him. Rule 4. The mathematical reality behind the rule beyond the psychological dimension. There is a mathematical reality that makes violating this rule almost mathematically guaranteed to produce eventual ruin for any trader who does it consistently. Consider a simple scenario. A trader enters a position. The price moves against them by 10%. Instead of exiting, they add to the position at the lower price, reducing their average cost. The price then moves against them by another 10% from the new level. They add again. This process continues. What most traders fail to appreciate is that the mathematics of loss recovery become progressively more punishing the deeper a losing position goes. A 10% loss requires an 11% gain to recover. A 25% loss requires a 33% gain. A 50% loss requires a 100% gain just to return to the starting point. A 75% loss requires a 300% gain. When a trader adds to a losing position and the position continues moving against them, they are not simply losing money on the original trade. They are losing money on an increasingly large position. The losses compound on a growing base, and the recovery required to reach break-even grows exponentially with each addition to the position. Livermore calculated these mathematics precisely. He understood that a trader who adds to losing positions is not engaged in a strategy with occasional bad outcomes. They are engaged in a strategy that guarantees catastrophic outcomes given sufficient time and sufficient adverse price movement. The only question is when, not whether. The rule against adding to losing positions is therefore not just psychologically sound. It is mathematically essential for long-term survival in financial markets. Without it, no amount of skill, intelligence, or market knowledge can prevent eventual ruin. With it, the trader's exposure to any single wrong decision is permanently capped at a level that can be survived and recovered from. Rule 5. How the rule works in practice. Livermore's actual method. Understanding the rule conceptually is one thing. Understanding how Livermore actually implemented it in his day-to-day trading is another, and the implementation details are where the real power of the rule becomes visible. Livermore did not simply refuse to add to losing positions. He constructed his entire trading methodology around a system that made the rule as easy as possible to follow mechanically. The system had 3 components that worked together to eliminate the conditions under which the rule would be most tempted to be violated. The first component was his concept of the pivotal point. Before entering any trade, Livermore identified the specific price level at which his thesis would be proven wrong. This was not a vague notion of how far the price could fall before he would consider exiting. T was a precise, predetermined level calculated from the price structure of the stock or market he was trading. If the price reached that level, the trade was closed, period. The second component was his practice of entering positions in stages rather than all at once. He would commit a portion of his intended position size on the initial entry, then add to the position only if it moved in his favor, never if it moved against him. This meant that his largest positions were always his most profitable ones, not his most stubborn ones. His capital naturally concentrated in his correct decisions rather than in his mistakes. The third component was his discipline of recording every trade in detail and reviewing his records regularly. By maintaining an accurate written account of every instance in which he had violated his rules and the consequences of those violations, he kept the lessons of past mistakes immediately accessible rather than allowing them to fade into convenient forgetting. Together, these 3 components created a system in which following the primary rule was the path of least resistance rather than the path of greatest resistance. He had engineered his trading environment to make disciplined behavior the default and emotional behavior structurally difficult. Rule 6. The rule applied to today's markets. The question of whether this rule applies to today's markets is one that deserves a direct answer. The markets have changed enormously since Livermore's era in their technical characteristics, but the behavior of traders within those markets has not changed at all. In the technology bubble of 2000, thousands of traders watched their technology stock positions decline by 30, 40, 50% and added to them at each lower level, convinced that the stocks were becoming better value with each price reduction. The stocks continued falling. Many fell by 90% or more before finding a floor. The traders who had been adding to their positions on the way down did not survive to participate in the eventual recovery. In the financial crisis of 2008, The same pattern repeated across different instruments. Traders who held mortgage-related positions watched them deteriorate and responded by adding, averaging down, holding on. The positions continued deteriorating until the losses became unsustainable. In every major market dislocation since Livermore's era, the same pattern appears with metronomic regularity. A significant portion of the losses sustained by retail traders in each crash are not the result of the initial decline itself. They are the result of traders adding to losing positions on the way down and then being forced to sell at the bottom when they can no longer sustain the losses. The rule Livermore refused to break would have saved the majority of those traders from the majority of those losses, not because it would have prevented them from entering positions that eventually turned against them. Wrong decisions are inevitable in any probabilistic endeavor, but because it would have ensured that each wrong decision produced a limited, survivable loss rather than a catastrophic career-ending one. The financial industry does not teach this rule today for the same reason it did not teach it in Livermore's era. The rule makes traders more resilient, more independent, and less dependent on the institutions that profit from their activity. But for any individual trader who is genuinely interested in long-term survival and profitability in financial markets, it remains the single most important principle ever articulated. And Jesse Livermore paid an enormous personal price to learn it and then apply it with absolute consistency for the remainder of his career. One rule, absolute, no exceptions, no negotiations, no hope. That is what separated Jesse Livermore from every other trader of his era, and it will separate you from every other trader of yours. Subscribe to Livermore Files, Classified. The next file we open might be the rule that saves your financial life.